Hi everyone. Today we're going to talk about stocks. What are stocks? Stocks are basically shares of a company that you would own. That's, let's say, a major corporation. So you have shares. Why are they called shares of a company? Because you technically own share of a company. The more shares that you own of a company, which are stock, the more they have to listen to you. So for example, let's say you're not happy how the company's being run. Let's say you don't like the CEO. The more money you put into that company and buy more shares, the more they actually have to listen to you. Historically, when it comes to investing, stocks have been one of the best places that you can put your money. The S&P 500, which is the United States 500 largest companies in the United States, those companies have averaged a return in the last 100 years of around 10% a year. Smaller companies, which are just basically smaller corporations, still big companies, they historically have made around 12 to 13% a year. But they move a little bit more. It's important to have a little bit of both, and we'll go into all that. So let's look at different types of stock. U.S. stock. These are basically corporations that are housed right here in the United States. That can be your Amazons, that can be your Googles, Microsoft. Just companies that basically do their day-to-day in the United States. It's important to have those, but it's important to not have only those companies. A lot of people have bias that, I just want to buy United States. No, you want to buy some international companies too. That can be like Unilever, which would be like your soap. That could be like your shampoo. You want to buy companies there's a lot of drug companies over there. You're looking at AstraZeneca. That's another good company that's in the United States, that's out of the United States. It's important to have all of these. And the reason that is in the 2000s, United States companies underperformed overseas. And then they flip-flopped. The next decade, which we're still in right now, United States companies have done even better than their international counterpart. By having a little bit of both, you're not guessing which one's going to do better. You want to buy good quality companies that you understand what they do, and it's important to have both. It's also important to have different sizes of companies. Different sizes of companies. That could be like, again, your large cap companies, mid-cap companies, and small cap. What's a small cap company? That can be like Discover Finance, that's your Discover card. Again, a big corporation. Discover makes, basically the market cap's around $10 billion. That's not a small company. So we're not buying these tiny little companies when you get worried about buying these small cap companies. You're still buying really good companies. But you need to own a little bit of both, because historically your portfolio will actually, your money will actually grow at a much easier rate and historically outperform long term. So it's important to have a little bit of both. I also want to go over what are growth companies, okay, and what are value companies. Growth companies, that is basically companies that the price will slowly go up over time, hopefully, and sometimes faster, because they're growing. They're growing at a much faster clip because they're making more and more money, because they're more and more profitable. What I mean by that is, these are companies that are just starting out. So think about it as a small business owner. When you start out, generally you're not making any profit. And if you are making profit, you're making that company bigger, better, stronger, faster, so you can grow and make more and more money over time. That's what they do with growth companies. Usually you got to have some debt too, because they have to try to build these facilities so they can make their product. So usually there's a lot of debt, but you're hoping in the future they're going to grow into a much, much bigger company and make you a lot more money over time. Value companies. Value companies, think about it as a business owner that now have been around for, let's say, 20, 30 years. They're now taking a salary. Okay, you're taking a salary from the company and you're hoping to still grow. That's what a value company is. That could be like your AEPs of the world. That can be a lot of banks like your JP Morgans and your Bank of Americas. Those are more value-oriented companies. That can be like ExxonMobil. Those are value companies. They pay a little bit of a dividend. I think ExxonMobil pays around a 5% dividend. That's important to have these companies, because that will allow you, one, if you're a little bit older, to sleep at night, and two, you're getting a little bit of income from your actual portfolio. So those two together are very, very powerful to make a nice portfolio for you.